you always pick a certain option's strike price? Imagine you're planning a trip and wondering which hotel room to book. Do you go for the cheapest, the most luxurious, or somewhere in between? Picking an option's strike price is just like that. It depends on what you want to achieve and how much risk you're willing to take. Option strike price is the price at which you can buy or sell the underlying asset. If you buy a call option, it's the price you can buy the stock at. If you buy a put option, it's the price you can sell the stock at. This price affects how much the option costs and how much you can potentially make. Choosing the right strike price depends on your market outlook. If you think the stock will go up a lot, you might pick an out-of-the-money call with a higher strike price. It costs less but needs a big move to become profitable. If you expect only a small increase, an at-the-money or in-the-money option might be better. These options cost more but have a higher chance of ending up profitable. Moneyness is another factor. In-the-money options already have intrinsic value because their strike price is below the current stock price for calls or above it for puts. They cost more but are safer bets. Out-of-the-money options are cheaper but riskier because they only gain value if the stock moves past the strike price. At-the-money options are in the middle, balancing cost and potential payoff. Your risk tolerance also plays a role. Conservative traders prefer strike prices close to the current price because they have a better chance of making a profit, even if the potential gains are smaller. More aggressive traders might choose out-of-the-money options to pay less upfront and aim for bigger returns, even if the chances are lower. Time horizon is important too. If you have a short time until expiration, you might pick a strike price close to the current price because there's less time for the stock to move. For longer-term options, you can choose strike prices further away, giving the stock more time to reach your target. Delta is a key options Greek that shows how much the options price will change with a $1 move in the stock. A delta of 0.70 means there's about a 70% chance the option will end up in the money. Traders use delta to decide which strike price aligns with their risk and profit goals. It's also helpful to imagine different scenarios. Visualizing how the profit or loss looks at various strike prices helps you pick the one that matches your expectations. If you want smaller, more consistent gains, a strike price closer to the current price might be best. If you're aiming for a big payoff, a further strike price might be more suitable. Market conditions matter too. In volatile markets, wider ranges of strike prices can help you catch bigger swings. When the market is stable, sticking closer to the current price makes more sense. Finally, your specific trading strategy influences your choice. For example, if you're doing a covered call, you want a strike price slightly above the current price to collect premiums while still having some upside. For spreads, you might pick to strike prices to limit risk and maximize reward. In the end, you should never pick a single strike price blindly. It's about matching your market view, risk appetite, and goals. Adjusting your strike price based on these factors can make your options trading more aligned with what you want to achieve.